when I talk to people about bringing products to market, it can't just be my value proposition as a product is I beat the market. That's a commoditized value proposition. For me, it's our value proposition of a product is, yes, we do think over the long run, this has the possibility to beat the market, but it does all this other really important stuff from a client sustainability perspective that makes it really unique.
Today's episode is brought to you by Fiscal AI, the fastest growing equity research platform on the internet. Later on, you'll hear more about Fiscal AI and in particular, what it can do for professional investors. But for now, let's get into it. Before we get started, I would like to do a quick disclaimer that nothing we discuss here is investment advice or marketing for newfound research, return-stacked ETFs, or any funds or strategies managed by Corey. Everything is meant to be informative about the investment management industry. Welcome to Other People's Money, the podcast about the business of investment management. I'm joined today by Corey Hoffstein, CEO and CIO of Newfound Research and co-founder and PM of Return Stacked ETFs. Corey, thank you so much for coming on the show.
Max, thank you for having me. This is a rare opportunity to talk about a topic I'm passionate about, but rarely ever get to speak about. So this is fun.
Well, I'm sure most people who interview you are asking something about quantitative or systematic investment strategies. I wanted to start out just by defining those terms. I feel like I see them used interchangeably. Like when you think about yourself, like, are you a quant? Are you a systematic investor? Or are they really just the same thing?
Yeah, I get this question a lot, especially from students who say they're interested in being a quant and maybe what should they do. And the first thing I always say is, well, what do you mean by quant? Because quant is this just massive field, short for quantitative, anything quantitatively related. I got my master's degree in computational finance, which is similar to a financial engineering degree, which is inherently a quantitative degree as it relates to finance. But my degree was all about pricing derivatives. And in particular, you were supposed to go work on Wall Street and price things like credit default swaps. And this was right into the 2008 crisis. So you can imagine how that played out for most of us who are looking for jobs. But quant, right, again, is this massive term. There are high frequency traders that are obviously quants. You can be a risk officer, and that's a quant role. You can do quant research. You can work on the buy side, and you can try to identify alpha signals, either at high frequencies, medium frequencies, slow frequencies. You can sit at a desk and use pen and paper to derive stochastic calculus equations to price interesting derivatives. That is quant as well. So when I talk to people about what is quant, it is a very big field. The application of mathematical models systematically applied with a computer is a small subset. But I think whenever you're using mathematical models and computer models to try to forecast whether risk or return, you're using those elements of quantitative investing. And when they're applied via some sort of computer program systematically, you're a systematic investor.
A lot of people have been talking about the current environment as being bubbly. And I guess as a quantitative investor, like, is bubbliness measurable? Are you comparing it to other periods of time? And as a quantitative systematic investor, like, is that even worth measuring?
This is largely going to depend upon what you're investing in, right? What is there a bubble in? I think when most people talk about a bubble, they're talking about equities. And here in theory, bubbles are hopefully measurable, right? Some sort of measure of price to fundamentals. And when that gets to an extremely extended, unjustifiable range, it's a bubble. But obviously bubbles are much easier to look at in hindsight because you can have highly extended valuations, right, of say price to earnings. But it's simply because your earnings aren't appropriately accounting for potential earnings growth. Are we in a bubble today, or are we going to see such massive productivity gains from artificial intelligence that actually the PE ratios are entirely justified? I will say that, at least in my career, every single year that I've been part of this industry, going back to, our company was founded in 2008, there has been someone loudly claiming there is a bubble. And they have largely been wrong. There have been cases where maybe things were frothy and things are cheaper, especially on the individual security level. But by and large, market timing is a very, very difficult decision. Very, very low breadth type of bet to make. And so I just don't think it's frankly worth spending much time on.
Well, I think that's a very interesting question because, as you said, quantitative strategies can take so many forms. Market timing is one of them. And there are people out there who are trying to use quantitative factors to come up with systematic strategies to time the market. Like when you look at the marketplace of quantitative systematic strategies, are there any, like, do you have tiers of ones that you think like are consistently worthwhile in exploring and ones that are like, chances are this guy is lucky?
The way I tend to think about it is like, what's the breadth of the strategy, right? So let's use market timing as our example. If you were trying to time global equity markets, you are taking largely a single in and out bet, right? I mean, you can size it up and size it down, but it's a single in and out bet that you might get to apply just a handful of times across your investment career, right? So you have something that compounds upon itself. So bad decisions are going to be really hard to make up for. You only get a couple of times to make it, and you're making it in one thing. It's really hard to prove any statistical significance in being good at that. And the costs of being bad are extremely high. Now, obviously, the benefit of being good, one good market timing call makes you Michael Burke, right? Especially when you get the payoff profile correct in whatever you invest in. You can be wrong for 15 years after. People still think you're a genius, right? So don't get me wrong, like a good market timing call can make a career, but it's hard to make a true investment strategy or business out of it. So those types of strategies that are extremely low breadth, when you see really good performance, I tend to think the person probably got lucky and it's a survivorship bias issue. You're not seeing all the other people who got it wrong. Versus when you're looking at a strategy that has incredible breadth, right? And a good fundamental reason for working. Someone who's running, let's just use an arbitrary example, like a merger arbitrage strategy, right? Where there's a good reason the risk premium should exist and they're diversifying across dozens, if not hundreds of securities, and it's highly repeatable over time. And they seem to have found an edge in identifying those deals that are underpriced by the market versus those who are overpriced, right? That's something that's repeatable and diversifiable and something I'm much more likely to believe that the edge is something that can and should exist over time. And so those are my big differences. I probably look at breadth as being like the number one way of saying, like, do I think that this is something that is repeatable or not?
What about like swing trading? Obviously, if you're trading at a much shorter time scale, you're getting more bets. Like, is there a short enough time frame where you could say, okay, this person has taken enough bets that clearly they do have some market timing skill, even if it's at an individual security level versus the whole market?
Yeah, I mean, look, if they have a huge number of bets, and there's a variety of reasons, like people might swing trade, right? Like you sort of have I'm going to use the word cliche here, but I don't mean this in a derogatory sense. If you have the cliche image of a day trader who is looking at charts, swing trading, 30-minute, hour bars, maybe a couple of days, and they get a huge number of bets over the year. And look, if they have identified a statistical edge, like if they can actually do that year in and year out in different market environments, there might be an edge there. You then get the question of, okay, what's the capacity of this sort of strategy? And what's the fundamental reason you have an edge, right? If you're reading charts, it might just simply be you are identifying some pattern, but you don't know the true reason why that pattern works. Those things can often be a little bit hard to go with. But I also know there's plenty of quant firms that attempt to use machine learning to digest different market patterns. And I don't mean patterns in candlestick charts, but patterns in data that they end up investing on and don't have a good fundamental reason either. So I don't want to be overly dismissive, but yeah, if you have a huge, again, I guess I'll call that depth, where you have done this repeated bet over time, then the question I'm going to ask is, how are you figuring out your bankroll per bet? Because again, this is a compounding game most of the time. And so if someone is overly aggressive in how they make those bets, all it takes is one bad bet for us to blow up the performance. And so then my question is going to be, okay, if I think you do have some sort of edge, how are you managing the risk?
Well, and then there's also the idea of like what was a good bet is now a bad bet. And like persistent risk premia, like merger arb is something that has been around for since M&A was invented. And then you have inefficiencies, which often disappear over time. So, how do you think about something as a sort of persistent risk premia versus an inefficiency, which may or may not exist for a given period of time?
I think with risk premium, you're talking about things where the risk is clearly identifiable. So again, we go back to merger arb as an example. When there's a publicly announced deal, the company that's getting acquired, the public company will typically jump towards the acquired price. So buying XYZ stock, it's announced the deal's going to go through at 40. It typically jumps towards 40, doesn't get exactly to 40. And that spread is going to be the market's priced, basically the market price of risk and the time value of money. So how long did they expect for the deal to take place? What's sort of how much should you get paid on a risk-free rate there? And then you can sort of almost think of it as an idiosyncratic credit in the deal getting completed, or whether you're going to have some sort of government intervention, or it's going to take longer than expected, or there's other weird hair on the deal. There might be a poison pill or something like that that makes it hard for the deal to complete. That said, in the US, once a deal is announced, it's very hard to get out of, right? I often point to Elon Musk and the acquisition of Twitter as an example of dude did not want it. He might claim, in hindsight, he's glad he bought Twitter, but he was trying as hard as he could to get out of it, and the courts forced him to buy it, right? So these deals are very binding, and yet the spread still exists. And it's because there's very real risk there. Maybe smaller than most people assume, but there is risk. And so if you're going to step in, you should get paid for it. There's also a little bit of arguably utility that people who are fundamental investors don't really care about that last percent. I would argue they could and should, from an actual annualized return, it's attractive, but they might say, well, their hurdle rate is much higher than what you can earn in merger arb for their cost of capital. And so it's to their benefit to sell. And so people who are willing to provide liquidity should also get paid. So you can make multiple arguments why merger arb should and be a persistent risk premium. That doesn't mean it can't get crowded, right? So any risk premium can get, just like owning equities, there should be a risk premium while you earn more into bonds over time. Doesn't mean it can't get crowded, can't get overvalued, and might not be worth investing at a given time. The other side is all the phenomena that we can't prescribe a very specific risk argument to, right? Those sort of anomalies. And those things, right, often, at least in the quant equity or sort of systematic macro space, we often talk about these ideas of do they have breadth? Are they persistent? Is there some sort of reason we can point towards the misbehavior of others as to why this exists? But they are candidly often a lot more faith-based. And you are saying, momentum's a great example of a premier anomaly that a lot of people implement that does seem to work across a great depth of data and a great breadth of different asset classes. It works in bonds, it works in stocks, it works in crypto, right? It works across all this stuff. There's really no good justifiable reason momentum should work, other than maybe some limits to arbitrage or misbehavior of other investors, some anchoring to old information. And you were fundamentally arguing about the irrationality of other investors most of the time. And so those sort of anomalies, I think, are unfortunately just more faith-based, especially at a lower frequency, right? If you're implementing momentum in equities, we're not going to know that the anomaly has disappeared probably until a dozen years after you first implemented, if not 20 or 30. And so for some of these, when you implement them at lower frequencies, it's just you don't have enough data to ever know whether they've truly disappeared, given the data we have that they have existed. An example there is the small cap premium. People thought that was a risk premium. It took 20 or 30 years for people to start to say, well, maybe this doesn't actually exist at all. And so for some of these, especially at a low frequency, you have to accept when you're implementing them, there is a high degree of faith associated. And that's why you're seeing a lot of quant firms move from what I would call low frequency to mid or high frequency, mostly low to mid, to try to get more samples to figure out what's actually working and what's not.
I think AQR did some work on the small cap risk premium to say, well, if you adjust for quality of companies, this is the quality of of small cap companies has gone down over time. How often do you need to sort of take that reassessment of these ideas?
Yeah, I'm of the increasing opinion that it's something that you should always be thinking about and asking yourself, right? I think in the same vein, you can ask, for example, how has the rise of passive investing affected market structure? How has the decline in IPOs affected market structure? How do those things flow through to the large versus small cap space and the potential risk premium you have, and thinking through how those companies for which you are earning a risk premium are actually going to be fundamentally repriced upwards, right? It's just a different world today than it was in the 1980s, both at an economic level as well as at an actual investment structure level. And so those are things we need to think about. And you've heard, Mike Green has very much been on the forefront of this, but you've heard other fundamental hedge fund managers say, well, if I'm going to play in the small cap space, I won't play unless I think there's a catalyst for which the stock either gets taken out or becomes a large cap stock, because passive flow is so important. I need to very much take into account who is owning this or who could own it as part of my investment thesis. And that's a big difference in investing in small caps than it used to be, right? It used to be you could just buy small cap value and you made money. I think there's a lot of people seeing how the investment landscape has changed to say, this idea of a persistent premium in something like small cap value, like we might have lost the catalyst. So we need to rethink through the catalysts that allow that premium to emerge, and that's going to change how we're investing in these things. So it's something to me that like the changes are slow, and in many ways might be like, I hate to use the phrase, but boiling the frog. Like a lot of people might not even be aware they've happened.
For many investors, financial data from Bloomberg, Refinitiv, Capital IQ, or FactSet is one of their biggest research expenses, with individual seats costing upwards of $20,000 per year. Despite these high prices, these platforms have been dominant in the financial data industry. That's because many of the cheaper alternatives don't actually own their data. Instead, they're licensing from these big data providers with terms that forbid them from allowing you the ability to download it. For professional investors, downloading and working with data in Excel is a must-have, and it's a major reason the proverbial Bloomberg killer has been so elusive. All of that is changing with Fiscal AI's new enterprise tier. At less than $2,500 per year, Fiscal AI provides much of the same stock market data at 1/10 the cost of Bloomberg. And you can download it all because they actually own the data. Instead of using huge workforces outside of the US to manually input data, Fiscal is using new AI technology to gather data directly from corporate filings, making it cheaper and faster than the labor-intensive incumbents. That's also why Fiscal's data is updated within minutes of corporate earnings releases. And before you ask, yes, they do have adjusted forward estimates too. Don't just take my word for it. Start a free trial today and use the link in the description to get 15% off any Fiscal paid plan, including their enterprise tier for professional investors. Let's get back to today's interview. Well, obviously, you cannot look at every single risk premium. Things are constantly changing, like you're saying, but your work looking into these sorts of things has resulted in you building a business in both newfound research and return stack ETFs. What did you start looking at 15 years ago, or a little over 15 years ago when you founded your business?
I'm going to give a very abbreviated version of my story. And the thing I always like to say to people is like my story in this space is not one that can or even should be replicated. So when I was still in college, I was very interested in markets, and I was getting a degree in computer science, and I started working on building some investment models for my own use, and was introduced to a local asset manager outside of Boston who saw what I was working on and asked whether they could license the research for basis points. And I was so naive, I did not even know what a basis point was at the time, right? That tells you how early I was in my journey. And so this company, Newfound Research, was founded, and it really was just an IP holding company. It was named after a lake I used to go visit in New Hampshire. And my intention at that point was to go to grad school to get my degree in computational finance and then go work on Wall Street. And in the period in which I created that company in 2008, graduated in 2009 from undergrad, went directly into grad school. The firm that was licensing the IP from me went from having zero in assets under management to getting a sub-advisory deal for a mutual fund and having several billion in assets. And as I mentioned, this was post 2008. The Wall Street jobs that I was getting training for were largely disappearing. I'd always had bit of an entrepreneurial itch, and I said, well, you know, let's go for it. And by the way, I should add, being young and having a business that is spitting off free cash flow, and like you, right, there's a very big part of the story, which is like I was just young and naive and arrogant, right? That I was like, 22 and ready to take over the world. I don't know why anyone would ever or should have ever trusted me in this situation. But I said, well, why don't I try this? Worst case scenario, I can always go back to work on Wall Street. And I basically tried to continue to grow the research firm, which was we have all these investment models. Can we license them out to other people? Problem was I had an NDA with my largest client. And so you had this 22-year-old running around Wall Street going, hey, you should license my research. I have a multi-billion-dollar asset manager who licenses it. And by the way, I can't tell you who they are, which, again, doesn't sound great. So I'm gonna accelerate this story. There's a very long, drawn-out story here, but I ended up ultimately saying I got to get up from the back seat of research to the front seat of asset management. Ended up launching a suite of mutual funds. We can talk about product, wrapper choices at some point. I think that was a mistake. That was an unforced error on my part. And then over time, we sort of moved from originally sub-advisory to advisory. We were an index provider. Everything we were doing was in the alternative investment space, and it just was painful being in that space in the 2010s when passive 60-40 was sort of unbeatable. And so over time, we got to this point of saying, well, how do we get these ideas, which everyone agrees in principle are good, like more diversification, all else held equal, is better than less, but in practice are almost impossible to hold on to. And so we looked towards the institutional space where there was this idea called portable alpha. And we said it would be great to bring this downstream in some sort of product wrapper. And so we started talking about it in 2017, and shame on me, it took me till I think 2022 to launch our first product in this space. But the benefit of waiting that long was my colleague Rodrigo Gordillo at Resolve Asset Management, who's our co-partner in all these funds that we manage. Came up with the term return stacking in that interim, and that's been a really powerful brand concept for us. And so the long story short is like I started in this quantitative research role, and over time evolved the business to offering ETFs to provide a very specific service. And that's one of the key lessons, and we can talk about that a little bit of like, I very dramatically changed how I think about running the business from being someone who cared about investment management to being someone who has to spend a lot of time focusing on asset management. And I think those are very different things. And whenever I talk to someone who's interested in launching a product and they love investment management, I always say you need to take a big step back, because if you don't love the idea of running an asset management business, like you're gonna fail, unfortunately.
I do actually kind of want to go back to the business of developing indexes, developing models, and then selling them. Like, what is that business like? How many basis points can you get? And obviously at 22, the idea that anybody was going to give you millions, billions of dollars is super low. So it made sense to sell off and license that research. Where does that switch flip? Like, where does it suddenly become a better business to go and try and raise your own assets versus, hey, I've got this great idea, let's go sell it to somebody who's got distribution already figured out?
So that is the key point, is distribution, right? There's a big cost difference in what you're doing, right? So when you're just purely licensing IP, you have personnel overhead, but that's really it, right? Data, people, and then you're not paying for the product wrapper, which can be very expensive. Your regulatory costs are typically much lower, and the sales team exposure and marketing exposure is typically a lot lower. But all of that means you typically get a smaller piece of the pie. Now, I should say that, like, in my experience, the fees came down dramatically in the 2010s. So in the early 2010s, and this may come as a surprise to younger listeners, like ETFs still really weren't as popular as they are today. It really took 2008 to bring ETFs to the forefront. And then we saw a huge acceleration into ETFs because the tax loss harvesting of 2008 like accelerated the opportunity for people to move from mutual funds to ETFs. And there's this whole category of managers called ETF strategists. And ETFs, and by the way, most of the firms there that were managing tens of billions of dollars like aren't even around today anymore. Like it was a flash in the pan. They got really big and then disappeared. But these ETF strategists were responsible for building ETF model portfolios, putting them on different platforms, and then advisors could subscribe their clients to those portfolios, whether they were strategic or tactical, and they were typically made entirely out of ETFs. When I started in like 2010-ish, you could charge 80 to 100 basis points for a model, an actively managed model. Those came down. Now, that doesn't mean for the research, I wasn't getting anywhere near that. But if you were delivering a fully baked portfolio model with all the support and investment advice that went along with it, it was around 80 basis points. Over the next 5 to 10 years, that went down dramatically. And then when BlackRock entered the space, State Street BlackRock entered the space around 2013, they offered models for free. Because the difference was the strategists didn't own the product. They were using other people's product to build a portfolio, so they had to get paid on the portfolio. BlackRock, State Street, all the big ETF providers said, well, we own the product, so why don't we just make the model free, and every dollar is going to flow into our own products. And that wasn't, a business model that the strategists, independent strategists, couldn't compete with. And so unless they had figured out a way to launch their own product, which is a whole other issue of distribution, they ultimately got competed out of the space. So ultimately, like that research of like what's a portfolio, what can you charge reasonably, unless you have a really captive audience, most of that has gone to zero. As an index provider, it largely depends what you're providing. Again, I would say like sub-advisory, it used to be a 50-50 split. That has also come way down. I think for very advanced indices, you're probably getting like, it depends on what you're charging. Right, an active equity strategy, I mean, you're lucky if you long only, you're lucky if you get 10 bips, might be 5 bips today. But that's because that product probably can't be more than 40 bips, right? That's also come way down. It used to be a 1% world. Active equity products are between 40 and 60 bips today. Now, if you're doing some sort of very intense alternative investment strategy, you might get half of the 100 basis point fee. But I would say most of the time, you're probably talking like 20% of the overall fee, if not less.
One thing that you brought up that I think is interesting that people miss out on is you said like all the other materials that the model portfolio provider was also passing along. Like at the end of the day, that there are investment advisors who have another client who is the person with the money, and their job is to look smart, look like they're making good decisions. So it's also about like the content creation that you are providing to these people in the form of research, so that when they have their quarterly meeting or semi-annual meeting or whatever, they have a story that they're telling to that end client. Like, how important is providing that sort of stuff as well as just the index that works to the advisor, who then there's another client a layer below them?
It is hugely important and also highly dependent, right? Part of my answer there is it depends on who you are selling into and what they are trying to do. And so here, and that's a bit of a complicated answer, but this is really a key question you have to ask yourself when you're distributing any of these products is like, who is your key client? What do they look like? And what do they need? I'm going to paint with very broad strokes here, and I apologize to anyone I preemptively offend here, but I have found in my career there's like a big generational gap of advisors who are older that were raised in a world where your value proposition was outperforming the market, right? They were raised back in the 80s and 90s where they were making cold calls and pitching mutual funds and earning commission, and all of that was always based on the idea of like, I've got a hot manager and I can beat the market. And there's many of these advisors that still believe that their job is to beat the market for their clients. And so often the collateral and support they want is performance related, right? Why is this going to outperform? What's the story? What am I telling my client? How am I explaining recent performance? What's, all that sort of stuff is important to them. What's the star rating? And that's a whole other game of like, How are you managing your fund in Morningstar and that sort of stuff? What sort of awards have you won? Then you've got what typically is a younger generation, though they're getting older as my career goes on, which goes, man, that is like a pretty bad value proposition to clients to build a business off of as a financial advisor. Because even if I'm good, it's like most managers don't beat the market every year, and so I'm constantly apologizing to my clients. What if my value proposition is financial planning, right? And I don't actually want to talk about investments with my clients. I want them to focus on, are they on track or are they off track? In which case, like, you have to provide much less collateral to the advisor, like in terms of like what they plan on passing forward to their client. At the extreme, they never talk about what's in the portfolio with their client. But what I found is they want to get educated and they want to be smart just in case the client asks them, what is this doing in the portfolio? And they never want to get caught off guards of like the investment behaving in a way that's unexpected and could potentially get the client off plan. So I find that the collateral you have to provide them is much more often risk-based, and getting them a deep understanding of the process and how it fits into the portfolio holistically. We do a ton of hands-on portfolio modeling for those types of clients, whereas there's a whole other cohort that just says like, I'm buying this because I think it's going to outperform, and that's the story, right? So segmenting your clients like gives you a very different answer as to what collateral they need and how they're going to use it.
So when you made that transition from providing research, providing indexes, model portfolios, to having products, who did you think your market was going to be, and what did you find out about that idea?
Yeah, so again, this goes back to my very weird story. So again, I don't want to go too much into it because it would take an hour and several beers. But my largest client had at the time, I think, 15 billion in assets. Rapidly went to 20 something billion. Um, but I would argue did so because they had committed marketing fraud. They had promoted having a live track record going back to 2001 when they didn't. And that live track record they purported to claim was actually a miscalculated back test. So what happened is you had all these clients of this product that loved the live performance, and the live performance was based on my research. And but obviously they had to get out of the product. And so my first jump into this field was simply, I need to launch a product so I have somewhere for all these assets to go, that they're opportunistic, long term. It's hard to say whether that was the right move or not. Like there was a cost associated with doing that we can discuss. But so when I made that jump, there's a large cohort of, when you're talking 20 billion, I mean, that is you're in all the channels, right? I mean, there was independent RIA assets, there was independent broker dealer assets, there was wirehouse assets, there were retirement assets. It was everywhere. And so for me, it was, I'm not even thinking about what channel am I selling to, who am I selling to. There was just money in motion that I wanted to have a fund where we could just say, hey, you like that? Well, it turns out we were really the people making it. Why don't you go around the middleman and just come to us?
And at that stage, could you say that, like, the NDA didn't apply at this
No,
stage?
but at that stage, everyone knew. It was
Okay.
this was written about in Fortune and Forbes and major news articles. I mean, this was back in 2013, a huge industry event, because you basically had a $25 billion asset manager go out of business, that like when the SEC came in. So it was no secret anymore. And so I had to staff up very quickly, get products out the door very quickly. But I had a non-compete on the exact product. So it was like, how do I come up with a product that's close enough that people would want to make the switch? And you learn some very quick lessons. Like when we launched the product, we weren't even available where a lot of people wanted to buy the product. Just because you launched it, like we weren't available at the wirehouses, we weren't available in independent broker dealers. So some people who wanted to buy us couldn't buy us, which ended up being a lost opportunity, and that was a hard lesson learned. But yeah, so for us, like we didn't even think about who the client is, because there was just money in motion, and we were just saying, hey, some of that money should land with us, and it did. A lot of that money landed with us. But in a weird way, I think it set me up for wrong expectations and wrong thinking about being an asset manager.
So what were those misconceptions?
You need to know who your client is, and you need to know why they're buying your product. And for us, there's a lot of money in motion, and I think we very quickly went from zero to almost $1 billion in assets under management. But they were never really our clients. Like, someone else had sold them on the product, and in my opinion, like, sold them with expectations that weren't really correct. So we had this whole like trying to re-educate process that was very difficult. They were getting to get to know a whole brand new firm. All their relationships were now different. And so it just, while the money quickly moved to us, it then like sort of just over time dwindled out, because we didn't have any of the processes in place to manage those client relationships well. We didn't really think about like our ability to then innovate on that product, upsetting a huge proportion of the market. The product that a lot of them bought at that point was 4 or 5 years old in design, and I thought there were ways that could be improved. I didn't realize they didn't want it improved, for example. Like, so there's the understanding who that client was. We got lucky to raise those assets. We got unlucky our client committed fraud. Lucky to raise those assets, right? But it put us in a position where we couldn't innovate. We got tagged with this product brand that maybe we didn't really want. It sort of handcuffed us to constantly helping those clients, but took our attention away from being able to build a business outside of it. Sort of shackled us to that one product idea, and that probably kind of put us in no man's land for about 5 years, frankly. It wasn't until I made a very proactive decision that I wanted to shut all that down and move on to other things that we really saw meaningful growth reemerge in the business.
So is that just the inevitability that these trends were not going to continue, or was there like actually you crossed a line in dollars where like, well, we're below this line anyway, so who cares?
It was the latter. It was, we're below this line. What we did, what that product was largely a tactical asset allocation product driven by quantitative signals. Those sorts of products raised tens of billions of dollars, if not $100 billion post 2008. There was huge demand for that type of product because everyone's driving, looking in the rearview mirror, saying, "Man, I need some way to hedge my equity risk if 2008 emerges again." Right? 2009 through 2020 was a buy the dip era. And so all those products just slowly bled to death as advisors kept having to apologize on behalf of the asset manager to their client. Now, I think part of that was just totally misguided expectations, right? In terms of what the performance and appropriate benchmarks were. But a lot of times you don't get to control what your benchmark is. As much as you try to explain to an investor or allocator what you think the appropriate benchmark will be, often they're choosing what they want to hear. And I think that was an era where they thought it was, we can capture 100% of the upside and none of the downside. And that's just not a reality for tactical strategies, especially when it's a buy the dip decade. And so a lot of those strategies just slowly bled to death. For us, we actually, ironically, it wasn't that. We had a very large client, 700 million plus mandate that the company was acquired by Goldman Sachs, actually. And when Goldman Sachs acquired the company, Goldman said all these models were firing all the managers. It didn't matter what your performance was. This whole category of managers were firing. And so we basically received a phone call where it went from $750 million to zero with a single phone call. And I looked around at my team and I said, okay, well, now's the opportunity to reset. We went from $1 billion down to 250 million with a single phone call. Like, that's client concentration risk, unfortunately. But it gave us the ability to say, we're kind of unshackled from this concept. Like, let's stop trying to make this work in a product that no one really wants anymore, and rethink like all the lessons learned, both from a product design and investment perspective. How can we bring something new to market that we think is not only good from an investment perspective and a long-term investment perspective, but is actually like a better product from an asset management business perspective?
So that's strategy and wrapper. Which of those two things did you really focus on first? Or, I mean, I guess maybe the wrapper decision had already kind of decided itself based off of industry trends.
Yeah, so the wrapper decision is a really interesting one. People, I think, give this, make it an afterthought, but the reality is there are certain strategies that are appropriate for certain wrappers and some that are not. And the problem that has happened post 2008, ETFs became the most popular wrapper, and for very good reason in most cases. But in some cases, the ETF isn't actually the best wrapper for a strategy, right? ETFs can't be closed. For less liquid components, you're going to get a wider bid-ask spread. All this stuff makes it so you can't trade certain types of assets. And so there are certain strategies for which actually a mutual fund is a better wrapper, right? You don't get tax benefits for certain types of investments in the ETF. And so, but what you've seen is firms say outright they'll never buy mutual funds again. And so if you want to, like you're having to swim upstream when you launch a mutual fund. Doesn't mean you can't be very successful. You absolutely can be. But, you're playing a harder game. So if you have a choice and all else is held equal, you want to launch an ETF instead of a mutual fund.
What about a private fund? I mean, obviously we all, not that 2 and 20 is the world anymore, but some performance fee sounds better than no performance fee.
Yeah, performance fees sound great if you can get them. It's just then a question of like how easy is it for you to raise capital, right? For a lot of people, they might not have the easy distribution. So I, for one, believe that when you're building an asset management business, many people will say, well, what's the investment strategy? To me, the equally, if not more important question to an asset management business is what's the distribution strategy? Because if you have a distribution strategy that doesn't align with your investment strategy, you're never going to raise a dollar, right? So, for example, if you say, well, we're going to do private investments and go try to raise money from independent RIAs, that's a very difficult strategy. If you say, well, actually, I'm just a super wealthy person living in Manhattan with super wealthy friends that want this investment strategy, yeah, private vehicle might make a ton of sense. So to me, the vehicle has to align both with the strategy. It can't conflict with the strategy, but then the vehicle has to align with your distribution plan. And for me, if you were to say, Corey, launch a hedge fund and go raise money, I'm not actually sure I could be successful. It's a totally different distribution channel, and it's not one I have experience in. And so I'm not, I might be able to hire someone who has experience, but I'm not sure our firm is set up, for the support and all the stuff that would need. The only thing I know is that I don't know, and so I have to hire someone to do it. But I don't think I could raise money in that channel by myself.
What about the strategy side? So you're moving away from tactical asset allocation.
Yeah, so I can talk about what we did, but I want to take a step back and just say, one of the big things that changed for me in this move of being someone who was solely focused on the research and solely focused on portfolio management to having to step into the CEO role of the business and think about building the business, building an asset management business was answering the question, why do people buy certain products? And what I came to was ultimately that products deliver a utility. That's sort of a weird thing to say, but to me, one of the questions was buying dividend stocks, as an example, is empirically worse than not buying dividend stocks, and yet you see high dividend yield ETFs gather a huge amount of assets. Why is that? People have a preference, a stated preference for just getting paid. They like the coupon showing up in their brokerage account. And so people flock to that sort of ETF. And that used to infuriate me on the portfolio management side, because I went, that is illogical. It's actually an edge you can probably exploit to generate better returns. But you should be indifferent between whether the dividend shows up or whether you just sell some stock to manufacture the dividend. And when I put the CEO hat on, what I said was, well, actually, I'm not indifferent. Like, these people have this preference, whether it's irrational or not. Like, that's their utility statement. So I need to provide like the product that matches that, right? And so that's been a big change for me. Is like, when I bring product to market, it can't just be, I think this is the investment, this is the best investment strategy. It has to be, in an ideal world, what problem am I solving for the client, right? With an idea of very much who that client is, right? So if I'm distributing to institutions, they have different problems than if I'm distributing to an advisor who works with, the mass affluent. Very different than if I'm providing a product to individual investors, different than traders, right? Like, the same product, the same idea might not work for all those people because they have different problems that you're trying to solve. So with that said, the problem we were trying to solve is, well, how do you get people to introduce diversification during a decade when no one cares about diversification? And so we got this idea from the institutional space around this concept of portable alpha, which was, you can have these independent alternative investment strategies that you can layer on top of your core betas, your stocks and bonds, so that when you build your portfolio, you can keep your core stocks and bonds without having, and introduce those diversifying, hopefully positively returning alternatives without having to give up the stock and bond exposure. And then for us, it was, okay, how do we put this into an ETF or a suite of products that is sort of like coherent and gives allocators an easy way to use them. So the way we designed it was very conscientious. How we mix these things together is very, very conscientious. And ultimately, the problem that we're trying to solve, and for our audience, it's financial advisors who are allocating on behalf of investors, is how to get those diversifying alternatives that the advisor wants in there in a palatable way, that the client isn't going to say, man, this alternative has underperformed stocks and bonds for 3 years. If you don't get it out of the portfolio, I'm going to fire you as my advisor. That's the problem we're trying to solve. And I think we've done an admirable job at it. And that's why we've seen, almost $1 billion of flows come in 2.5 years into the suite.
So I guess, is that just hiding the ball from the person? They don't see it, like, when they look at it? Or is it the way that it's layered and sized or whatever makes it so that it doesn't have some of the negative characteristics, right? Is it hiding the negative characteristics or eliminating them?
Hiding, but I don't think that's a bad thing, right? So because what I think is important here is, like, this isn't hiding in some sort of negative way. This is, okay, I believe, let me give an example. I believe gold goes up over time. My client doesn't start with a blank piece of paper. They start with a 60-40 portfolio. And so if I'm trying to put gold into that portfolio, the question I have to answer is, what am I selling to make room? Maybe I sell some stocks, maybe I sell some bonds, maybe I sell a combination of both. But whatever I sell creates a very real opportunity cost from, like, a mathematical perspective, right? Gold needs to outperform that thing on an after-tax basis most of the time for it to have added value, ignoring some of the diversification benefits. And two, it's going to create behavioral frictions. As much as everyone loves gold today, I remember the era where everyone hated gold for almost a decade, right? And so if you would put gold in there instead of your stocks and bonds, clients were coming in every single year going, why do we own gold? This is a pet rock. Like, this doesn't make any sense. So
Reading too much Joe Weisenthal.
Exactly. So what you can then do is say, well, what if, there's a product that for every dollar you invest, you get $1 of stocks plus $1 of gold as an overlay. Now what you do as the allocators, you sell some of your stocks, you buy this product, you keep the 60-40, and you get gold as an overlay. Now if gold goes nowhere for a decade, great, the 60-40 is still there. The opportunity cost is different. Gold starts going up. If if there's debasement concerns, whatever it is, you still have it in the portfolio. And so you can hopefully benefit for the client from the long run expectation that gold's going to go up over time, assuming you believe that. Now you look at the client from a portfolio perspective, right? They don't have the same opportunity cost. But then when you think about putting it in a single line item and you're blending, say, stocks and gold together, well, now the client isn't going to see all the weird zigzags of gold. It's still going to stand out. It's not like, just because you blend gold and stocks together doesn't mean that gold totally disappears. But that line item might be a little bit more palatable to them. And so this is what I mean from an asset manager, where I can say, well, I think I have a really interesting product that gives people access to a strategy that they can't implement otherwise. So we're providing a real service. We're allowing the allocator to introduce something that they think is going to add beneficial portfolio characteristics, whether it's return, low correlation, diversification, whatever it is. And there's hopefully a unlock from a behavioral perspective for the client. Well, now all of a sudden you have a product that solves multiple things that aren't just performance related, right? And that's what I think is really key when I talk to people about bringing products to market is it can't just be my value proposition as a product is I beat the market. Like that's a commoditized value proposition. For me, it's our value proposition of a product is, yes, we do think over the long run, this has the possibility to beat the market, but it does all this other really important stuff from a client sustainability perspective that makes it really unique.
So obviously, if you're providing more than 100% exposure, you're utilizing leverage. How does it differ from using this, dollar of stocks, dollar of gold example, from buying a 2x levered equity ETF with 50% of my money and then buying a 2x levered gold ETF with the other 50% of my money?
Yeah. So assuming they have the same fees, which they don't, but let me give the benefit of the doubt. A lot of people don't like the 2x funds. I think your question is perfect because it highlights if you strip the fund off it, behind the scenes, they're really the same. Now, there are some important implementation differences that can emerge, right? And there are some costs that can be different. Like you need to do your due diligence here. But in theory, if they're managed the same way, like if I put 100% of my money in a 100 versus 50% of my money in a 2x, instantaneously at a point in time, they're the same, right? What happens then is you have day-to-day drift. And so with the 100, the way we manage our funds is they get internally rebalanced. Whereas if you do the 2x, the rebalancing is on you.
Now, I want to change the conversation a little bit because obviously you have to, not that it's entirely, you're the only person who's ever thought of this. As you said, you're taking it from the institutional space. So this is an idea that has existed before, but it's certainly newer to the investment advisor community that you're targeting. You're not trying to go to these institutions that already have the ability to do this type of layering themselves and saying, well, you can do it with me through an ETF product and I'll, cut your costs in half. Maybe you are doing that. Sorry to speak for you if you are in fact targeting that group. But I imagine there's a lot of education. Certainly anybody who knows who you are has followed you probably on Twitter, has read some of your papers, maybe listened to Flirting with Models or other podcasts that you've had over the years. So clearly you take content creation very seriously. Is there a flow through from research to social to podcast? How do you think about creating content and educating an audience and building an audience?
I'm going to answer your question, but I want to address your comment about going to institutions. We don't go to institutions, and it goes back to the question of what problem are you solving for investors? The problem we help solve is that RIAs and most individuals can't do this because they can't manage the leverage themselves, right? Why would anyone buy a 2x ETF? Why don't they just go buy futures? Because most people can't buy futures, especially RIAs are largely prohibited from buying them. And by the way, most RIAs are prohibited, at least at independent broker dealers and wirehouses, from buying the levered ETFs, those 2x funds. So what we do in our combination actually solves a problem for a lot of those people, an operational and compliance problem. So again, when I talk about like, what does a product do? Your value proposition from bringing a product to market can solve more than just we beat the market. It can do all these other things that are important and critical that lead to adoption. And I think that's the way you need to think as an asset manager. None of that is true in the institutional space. These mega institutions get so much service from so many different providers and they are competing with each other and drive costs down so low that, like, a large endowment does not need to use my ETF. And in fact, I don't want to say they're worse off, but they will likely get a much better deal going outside of a regulated vehicle because of all the costs we have associated, and going direct to a large bank to finance their leverage. They can probably get it done much more cheaply because if they don't feel like they need the regulated vehicle, they just want a pool of one SMA, like that's just better for them. So we don't solve their problem. And it's no wonder then that they don't allocate to us, right? And again, this is the way I think a lot of portfolio managers go wrong when they want to launch product. They're not thinking about whose problem they solve. So to your question about content creation, yes, content creation has been really key and core to everything we do. And I think of it a couple ways. One, I think it was as just a way to educate people in a generic brand building exercise. And I don't think of it necessarily as measuring the ROI of it, right? I don't go, I'm going to create this piece of content and it's going to cost me this many man hours. A lot of the content I create, it's impossible for me to quantify. I publish research. Some of it's in journals that I doubt anyone has read. Then there's other stuff that it's gone viral, right? That is much more appealing to most people. I look at all of that as it's important to try to build the brand halo around yourself of being a thoughtful investor, because then people tend to give you the benefit of the doubt when you bring something new to market, and they've heard of you and they'll take the call. From there, right? So to me, it's like from a pure business perspective. And again, I say all this as if business is the only thing. I love this stuff. I'd probably be writing this content anyway. Like the podcast, I don't make any money from, but like there's a value to it of building the network and meeting people and learning interesting things. And like that's where the passions lie. But from a business perspective, I go, okay, that's all top of funnel. Then I very much think of the content as how am I helping the sales team move people through the funnel? So the best article ideas come from the sales team saying, my client asked me XYZ, and I didn't know how to answer it. It's sort of a complex question. And I go, great. Give us a week and a half. We will write an article about that. And you can send it directly to that client, but you'd better believe if that client's asking the question, someone else is thinking it, and someone else is going to ask it again. And so then our goal is to build sort of a compendium of articles that when anyone asks a question, it's not just like we can write them a quick one-off paragraph. It's like, here's the TLDR. Oh, and by the way, if you want to go deep, here's a whole article we wrote about it. And by the way, if you want to go deeper than that, here's a white paper we wrote about it, right? And it gives people the ability to know, like, there's some real depth of thought behind what they want to learn about. And so, again, we go back to your question, like, how do we think about this? Like, Twitter, podcasts, general, just being out there to me is broad awareness. Get people in orbit, and they just, some people might immediately ask about product. Some people might take 5 years until they're in a position where product might make sense. But just keep them in orbit and keep giving them really interesting thoughts and ideas, and maybe something connects, maybe it doesn't. Maybe they never come in, but they know someone else for whom there's a connection, right? There's just hard to measure benefits of that. And so there's a lot of that going on. And then it's, once we connect, all the content is driven towards helping the sales team better educate, both for converting a prospect into someone who becomes an allocator and keeping those allocators, right? That is equally, if not more important than converting a new allocator. Is for every allocator we get that gives us their business, like we need to retain their trust and continue to show them that the products are delivering on the value proposition that they initially bought into.
You talked about virality. Do you have any clue what's going to go viral? Is it always a surprise?
I know it's not going to go viral. That's easier. That's easier. Look, I have, viral for the finance world is like, what does viral really mean? I wrote a paper a couple of years back called Liquidity Cascades. That probably went about as viral as something can go. It probably got downloaded 35 to 40,000 times as a paper. It wasn't a huge surprise to me that it went viral. It's a paper that's a little conspiracy theorist. It was of the times and in the zeitgeist, and we came out of March 2020 and markets were wild, and you had a whole bunch of people trying to figure out what is going on. Like, why does this market feel so different? And it tried to address all that in ways that I think captured a lot of attention. It talked about impact of central banks. It talked about the impact of passive flows, both at a macro and micro market structure. It talked about the impact of the growing derivative space, right? And so, because of all that and the way the paper was designed, it was one of those that was like, this one has a good chance of going viral. Versus, I write a paper on replicating trend following. Like, is that going to go viral? Absolutely not. But which one is ultimately more important, right? They're going to serve very different needs, because the one that is about liquidity cascades that got our name on everyone's radar doesn't really support our products necessarily. So it creates brand awareness, but you still need to convert that brand awareness to product awareness, which is a big step, right? And you need, like, of that 35,000 people, how many people stayed in orbit? I don't know. How many people then converted to listening to the podcast or reading our other research? It's hard to say. It's hard to track, especially on the podcast side. So virality to me isn't even something that I think about a lot, because going viral often means that it's such a top of funnel piece of content that, like, it doesn't actually help us grow the business.
Yeah, and I also think about like just publishing into the void, right? Like you can have great ideas, but they do still need to reach people. So it's not necessarily viral, but that it's distribution in its own right. It's a different type of distribution. It's not product distribution. And so I think you are somebody who does this really well. You play nicely with others online, and I think the podcast is a fantastic way to do that, to grow your network. But you also do it on social media. How do you think about like amplifying other people's work that you think is good? Because one day they're gonna come and say something nice about your work. Like so many people think it's a zero sum game out there, and I don't necessarily agree when it comes to social media and building an audience.
When you're a $100 billion asset manager, the math might be a little different. When you're $1 billion asset manager, there's a lot of assets out there, and cross pollinating with your peers is a great way for you to both win. So there is a strategic element of this. There's a strategic element of, like, one, I don't want to crash out, on Twitter. Like, it takes, what do they say? Warren Buffett says it takes, a lifetime to build a reputation and to be ruined in an instant. Probably wasn't Warren Buffett. Probably someone else, and I'm embarrassed. I can't remember who said that. But so part of it is, like, I just have there's things I don't talk about on Twitter. I will not talk politics as a general rule. There's no benefit to me talking about politics. I would be surprised if my followers actually even knew what my political leanings were. Like, that's a very conscious decision, because I don't see a benefit. For some people, there might be a benefit. Like, flag planting and collecting your tribe is a great way to build a business, especially if it's adversarial. That's just not the type of business I'm building, and so it's less relevant to me. So it's a very strategic decision to only talk about certain things, and it's a strategic decision to play nice. That said, I will say that my life got a lot better when I earnestly started celebrating the wins of my friends and peers. So a lot of my quote unquote competitors, like, I don't actually think I have that many competitors. I have a lot of peers in the space who do great things that are totally different from me and eat up different parts of the allocation pie. And, when you're not doing well, it's easy to be jealous of their wins, but it's such a hard space. And I've known so many of them for so long, and I've seen them go through struggles, that like watching them win and being earnestly joyful for their win has just made my life better. And so I celebrate my friends not because it's always just a strategic business decision, but I've actually found it just makes me happier as a person to want to celebrate their wins rather than like harbor any jealousy about it.
So I want to go back to another idea, and that's building product awareness. You can't always talk about product. Like when we started this conversation, you said, "Look, if we talk about a ticker, I'm not going to be able to share this. It's going to have to go through 13 layers of compliance." Right? So how do you build product awareness without actually pushing product? And how does that work?
Yeah, that's really hard. And again, this is where I think a lot of people who come into this space with an idea about how distribution can work don't and have never been in this space don't realize how hard compliance can be. Like someone will ask me a question about one of our ETFs on Twitter, and I can't even answer them about the ETF on Twitter because that tweet is public, and so it's considered marketing, and so that tweet then has to go through multiple layers of compliance. So I have to DM the person because the one-on-one conversation is not, doesn't adhere to the same regulatory rules. So it's a very complex question. So that's frankly why you see so many firms publish research. It's a way to build the brand. And then the goal is, okay, someone's downloaded our research. Hopefully they've gone to our website. They might get pinged on the website and be like, have you checked out our products? Or the sales team will see someone submit a request for a white paper that they're interested in, and the sales team will proactively reach out. But really, there's a couple of things like that. You can host conferences, but a lot of times you're just talking in generic concepts because that's what you can talk about the most. I can talk about what return stacking is. I can talk about why I think it's so beneficial, both from a long-term portfolio construction perspective as well as a client behavior perspective. And then the best I can do is hope that I touch enough people that they then go, that's interesting. Let me go Google that, and then they land upon us. And then hopefully we can, through our website, guide them on the journey towards answering the questions they have and or getting them in touch with a representative at the firm who can help do what they need, whether it's, model portfolio risk or go through the different products and explain how they work or give them a deep dive or connect them with a PM or whatever they need. But that is probably the biggest gap, right? Life for me would be infinitely easier if I could just like hold promotions and talk about tickers all day long, but it's just not, it's not possible.
I want to close with a different question as it relates to digesting that type of research, right? There's good research, good back tests, and bad back tests. So if you are somebody who is a generalist, they don't have a master's in financial engineering, how would you recommend people engage with research that is presented as academic but has these other motives to it that you kind of openly talk about, which is to build a brand and to build awareness for your products? So if you were somebody who is engaging with this type of material, what should you be looking for to make sure the information you're getting is accurate and useful?
For junior quants, one of the things I always recommend is go try to find these papers and build the back test, because it'll not only teach you about building back tests, but then you'll realize all the assumptions and all the fluff that can be baked in and all the ways in which this stuff is brittle and can break. So there's a couple things. The first thing I always like to remind people is that, again, I'll reference Mike Green here because I think this is a paraphrasing of him. Like a back test is just like a single back test is just a replay of history, and history is just one path of an infinite number of possible paths markets could take. So whenever I look at a back test, the way I like to think about it is not as being confirmational as to whether a strategy works or not. Obviously, we're going to care about all those statistics, but what I'm trying to figure out is like, did it break in the regimes I would expect it to break in? That's just as important as did it work in general. Like if we are looking at a back test that is purely going up and to the right and it never falters, all that means is we've learned nothing about the conditions in which it breaks. You want to see the conditions in which it breaks. And then two, we need to be hyper aware that, like, again, this is just the historical regimes we've seen. Real back tests, in my opinion, are include a huge amount of like simulation. But what you'll also find is like a lot of quants are moving, not to say that they're moving past back tests, but they're moving to a point of like there's a fundamental thesis for the data is getting incorporated in, and the optimizers are doing a whole lot. So when you're seeing a research paper on a single signal or something like that's not really how quants think about the world. Which raises sort of the second point, which is like, why are you seeing this paper? Right? You need to know when you're reading a paper who the target audience is. If you are a non-quant and you're reading a paper and you understand it, right, it's probably a marketing piece, which is fine, but you need to accept like that means you're the target audience, and the real details of how this thing has been implemented probably aren't even contained within that paper, and you need to accept it's a marketing piece. That doesn't mean there isn't very good information in marketing pieces, but like take it with a grain of salt. You're being marketed towards, again, I don't say that with any sort of negative connotation. Like, we all need to do marketing. That's how we create awareness, but like it's not a robust research piece. Then you go to the next step, which is okay, maybe there's a real academic paper, in which case you have to answer like, what's the intention behind this paper? Why are they writing it? Some of them are actually thinly veiled marketing pieces for more institutional clients, right? And then you get the pieces that are like, this is really written for nobody, and those are probably the most pure pieces, right? Like I've written articles that I go like, I don't benefit from this. This is just a cool piece of research that I think should exist. Like this does not help my firm in any way. Those are probably my most authentic pieces, and anyone who reads that could probably go like, Corey is providing his most objective viewpoint possible with these research articles. And yeah, maybe they're published in journals, maybe they're not, but they're not targeted towards anyone, and they don't benefit me. So understanding like where in that pipeline of why it's coming out is really important. The last thing I'll say is like, no one really wants to disclose true alpha, right? So if someone's writing a paper and says, "Oh, this is an alpha signal that's going to outperform the market," like unlikely, right? It just real alpha stays between practitioners and often doesn't get written about until well after the fact. And so it goes the same idea, like where are you in the content ingestion pipeline? If you are not in that risk taker seat where you're talking to a lot of other PMs and really digging into where alpha is in the market today, like by the time that stuff reaches you, it's probably pretty diluted, and you should take it with a big grain of salt. Either the research has been done incorrectly or it's largely already been arbitraged out of the market.
I'm sure you see this with having a podcast about quantitative strategies, but one of the nice things about having a podcast or a YouTube channel is you get comments back and you can kind of see where the generalist investor is on things. And we get comments all the time like, when are you going to bring on somebody who has like an AI investment strategy that's way cheaper than all of these hedge fund managers you bring on? I'm just like, if there was an AI strategy that could beat these hedge funds, it certainly wouldn't be cheaper. And so with the advancement in AI, like what is the commentary that you're seeing out there similar to that you think people just have like completely wrong about how artificial intelligence might impact quantitative strategies and products that are available to the general public?
It's funny. I actually don't get a lot of feedback on that, probably because my podcast is so niche. You're talking about niche podcasts. I mean, my podcast is called Flirting with Models, and anyone who listens to it is probably 90% disappointed because it has nothing to do with actually flirting with models. These are systematic investment conversations. And the interesting thing is, I think practitioners are still questioning how AI and machine learning are ultimately going to impact what they do. A lot of this stuff comes into vogue and becomes very popular. It's popular for allocators to ask us the question. And so then we want to talk and write about it because it's helpful from a brand building perspective. But in the actual risk taker seat, certainly these things are being used. Machine learning, absolutely being used by almost every major quant firm I know. AI, and again, we can sort of smudge the distinction between what they mean, like large language models and that sort of stuff. Like, yes, it's starting to get introduced absolutely for the analysis of transcripts and all that sort of stuff, like powerful stuff. But standalone AI coming up with its own investment thesis. Like you're still seeing people trying to figure out how to harness these concepts and figure out where the limits are and how you handle the failure edge cases. And there's a big question as to like, is that the appropriate use case of this stuff, or is it more in the research side? I recently wrote a paper where I just there's research out there on certain topics that I needed supporting evidence, and I needed someone to challenge me and help me work through some math. And ChatGPT was actually phenomenal at it as a research assistant, and I see it getting used that way a lot. But is it going to be a standalone hedge fund replacement? Again, I think the first firms that are likely going to do this are going to do it in the 2 and 20 capacity, right? And then maybe it takes a decade to come downstream, if not more. But we don't know what the final form is going to be. That's my bad answer here. Is like, this is still, look at where this stuff is today versus where it was 5 years ago. We are leaps and bounds, and it's changing so quickly that it's hard as a firm to have a pure strategic investment in a single direction, because it could be totally invalidated in 3 months.
I think you're a bit too bullish saying 2 and 20. I mean, I think the people who are at the leading edge of machine learning are charging 3 and 30, 4 and 40, that kind of stuff.
If they're even taking money, because I know a bunch of people that are right, they're just running their own prop money.
Exactly. Well, Corey, thank you so much for doing this, for sharing a little bit about how you think about the asset management business. Anybody looking to find you or follow you is at C Hoffstein on Twitter, the best place?
That is the best place.
All right. Thank you very much. And anybody who enjoyed this podcast, please give us a review, a like, a share, whatever. And also check out Corey's podcast, Flirting with Models. You can get it anywhere you're listening to other people's money. I hope you enjoyed today's episode. Looking to learn more about Fiscal AI? Check out the link in the description to get 15% off any paid plan, including Fiscal's Enterprise tier, which is designed specifically for professional investors who need access to downloadable data. Until next time.